Warren Buffett is often described as the greatest investor of all time. Yet when people look closely at his life, something unusual appears. He does not behave like the stereotype of a billionaire. He lives modestly. He speaks simply. He avoids complexity. And he thinks very differently about money than most people. The success of Warren Buffett is not based on secret formulas or complex trading systems. It is based on principles. Simple principles followed consistently for decades. This book explains those principles and shows how ordinary people can apply the same thinking in their own financial lives. At the core of Buffett's philosophy is a simple belief. Investing is not about predicting stock prices. It is about owning great businesses at sensible prices and holding them for a long time, thinking like a business owner. Warren Buffett does not think like a trader. He thinks like an owner. When he buys a stock, he is not buying a symbol on a screen. He is buying a piece of a real business. He asks the same questions a business owner would ask. What does this company do? How does it make money? Why do customers choose it? Can competitors easily replace it? Will this business still exist in 10 or 20 years? If he cannot understand the business, he does not invest. Complexity is a warning sign, not an advantage. This mindset alone separates Buffett from most investors. The circle of competence. One of Buffett's most important ideas is the circle of competence. Everyone has areas they understand and areas they do not. The key is not knowing everything. The key is knowing what you know and staying within it. Buffett avoids industries he does not understand. Technology for many years was one of them. Not because it was bad, but because it was outside his circle. He never feels pressure to follow trends. He waits. Waiting is a skill. Why simplicity wins? Most people believe investing must be complicated to be successful. Buffett believes the opposite. Simple ideas executed consistently beat complex ideas executed poorly. He avoids constant buying and selling. He avoids predictions. He avoids reacting to news. Instead, he focuses on fundamentals: revenue costs, cash flow, debt management quality. Simple questions, clear answers, economic moats. A key concept in Buffett's approach is the idea of an economic moat. A moat protects a castle. An economic moat protects a business. This moat can come from strong brand loyalty, low production costs, high switching costs, network effects, patents, or unique processes. Businesses with strong moats can raise prices, maintain profits, and survive competition. Buffett prefers fewer investments but stronger ones. Management matters. Buffett pays close attention to the people running a business. He looks for managers who are honest, rational, and shareholder-friendly. He prefers leaders who think long-term rather than chasing short-term rewards. He avoids companies where management is focused on appearances, hype, or excessive compensation. Good management protects investors even during difficult times. Financial strength and discipline. Buffett avoids companies overloaded with debt. Debt reduces flexibility. Debt increases risk. Debt creates pressure during downturns. He prefers businesses that generate strong cash flow and can fund their own growth. Financial strength gives a company freedom. Freedom to invest, adapt, and survive. Buying at a sensible price. Even the best business can be a bad investment at the wrong price. Buffett does not chase rising prices. He waits for reasonable valuation. He looks for a margin of safety. That means buying when price is below reasonable value. Patience creates opportunity. Long-term holding. Buffett famously said his favorite holding period is forever. He believes frequent trading destroys wealth through fees, taxes, and emotional decisions. By holding quality businesses for long periods, compounding does the heavy lifting. Time becomes an ally. Emotional control. One of Buffett's greatest strengths is emotional discipline. He remains calm when markets panic. He remains cautious when markets are euphoric. He understands that markets move based on emotion, not logic. Instead of reacting, he prepares. This emotional control protects him from costly mistakes. Why Buffett avoids predictions. Buffett does not predict interest rates, market movements, or economic cycles. He believes predictions create false confidence. Instead, he focuses on what he can control. Quality value, discipline, patience. This mindset reduces stress and improves consistency. Learning from mistakes. Buffett openly admits his mistakes. He studies them carefully. Mistakes are teachers, not failures. He adjusts his thinking and improves his decision-making. This humility is rare and powerful. The Buffett lifestyle. Despite massive wealth, Buffett lives simply. He avoids lifestyle inflation. He avoids unnecessary complexity. He avoids distractions. His focus remains on what matters. Clarity improves performance. What ordinary investors can learn. You do not need Buffett's intelligence or resources to apply his principles. You can. Invest in businesses you understand. Avoid unnecessary trading. Focus on quality value patience. Ignore noise. Think long term. These habits alone put you ahead of most investors. The real lesson. The Warren Buffett way is not about beating others. It is about consistency. It is about discipline. It is about avoiding mistakes more than chasing brilliance. Wealth grows quietly when decisions are calm and rational. One of the most misunderstood parts of Warren Buffett's success is how slow his process actually is. From the outside, people see the results and assume constant action. In reality, Buffett spends far more time thinking than acting. He reads extensively. He studies annual reports. He waits. And when the right opportunity finally appears, he acts decisively. This patience is not passive. It is active discipline. Buffett understands that doing nothing is often the best decision. Markets constantly present noise. Prices move, news breaks, opinions flood in. Most investors feel pressure to respond. Buffett feels no such pressure. He waits for clarity. Waiting protects capital. Waiting avoids mistakes. The importance of focus. Buffett believes that focus is a competitive advantage. Instead of owning hundreds of businesses, he prefers to concentrate on a smaller number of high-quality companies he understands deeply. He would rather know a few businesses extremely well than know many businesses poorly. This approach requires confidence. It also requires humility. Confidence to hold strong positions. Humility to admit what you do not understand. Many investors spread themselves too thin. They chase diversification without understanding. Buffett diversifies, but only after deep conviction. Understanding business economics. When Buffett studies a company, he's not impressed by growth alone. He studies how that growth is achieved. He asks practical questions. Does this business require constant reinvestment just to survive? Does it depend on trends or fashion? Can it raise prices without losing customers? Is demand predictable or unstable? Businesses with stable economics are favored. Predictability matters. Businesses that rely on constant innovation or perfect timing carry higher risk. Buffett prefers businesses that sell simple products people use repeatedly. Products people trust. Products people rarely reconsider. The role of brand power. Strong brands create pricing power. Pricing power protects profits. Buffett values companies with brands that customers trust instinctively. When customers are loyal, competition becomes weaker. When competition is weak, profit margins remain healthy. When margins remain healthy, long-term returns improve. Brand strength is not built overnight. It takes years of consistent delivery. Buffett values that consistency more than rapid expansion. Cash flow. Over-accounting tricks. Buffett focuses on cash flow rather than accounting illusions. A company can show profits on paper while struggling in reality. Cash tells the truth. Strong businesses generate cash consistently. They do not rely heavily on debt. They do not constantly issue new shares. They fund growth internally. Cash gives flexibility. Flexibility protects during downturns. Debt and risk management. Buffett is cautious with debt. He understands that debt magnifies both success and failure. In good times, debt feels harmless. In bad times, it destroys businesses. He prefers companies that could survive difficult years without outside help. This resilience matters more than short-term growth. Ordinary investors can learn from this. Avoid businesses and investments that require perfect conditions to survive. Choose resilience over excitement. Market volatility is not the enemy. Buffett does not fear market volatility. He welcomes it. Volatility creates opportunity. When prices fall due to fear, quality businesses often become undervalued. Buffett prepares for these moments by maintaining liquidity and emotional discipline. Instead of reacting emotionally, he prepares rationally. This mindset turns market downturns from threats into opportunities. Long-term compounding. Compounding works best when left undisturbed. Buffett understands that time, combined with quality and patience, creates exponential results. Many investors interrupt compounding through constant trading. Taxes, fees, emotional decisions. Buffett avoids all three. He lets time do the work. This is why his greatest gains occurred later in life. Compounding accelerates quietly, then powerfully. Avoiding the crowd. Buffett is comfortable being alone in his thinking. He does not follow trends. He does not fear missing out. When others are greedy, he becomes cautious. When others are fearful, he becomes interested. This contrarian mindset is not about being different for attention. It is about being rational when others are emotional. Independence of thought is rare. It is also valuable. Simplicity in personal life. Buffett's simplicity extends beyond investing. He lives a modest lifestyle. He avoids unnecessary complexity. This simplicity supports clear thinking. Distractions consume mental energy. Buffett protects his focus. He proves that wealth does not require extravagance. It requires clarity. Learning as a lifelong habit. Buffett reads constantly. He treats learning as a daily responsibility. Markets change. Businesses evolve. Knowledge must be updated, but core principles remain unchanged. By combining continuous learning with timeless principles, Buffett stays adaptable without abandoning discipline. Mistakes and humility. Buffett openly discusses mistakes. He does not hide them. He studies what went wrong. He learns. He adjusts. This humility protects him from repeating errors. Ego destroys investors. Humility strengthens them. Admitting mistakes is not weakness. It is wisdom, what individual investors can apply today. You do not need large capital to follow Buffett's approach. You can. Focus on what you understand. Avoid emotional decisions. Limit trading. Think long-term. Value quality. Ignore noise. These habits alone dramatically improve results. The deeper lesson. The Warren Buffett way is not about brilliance. It is about behavior. It is about avoiding mistakes. It is about patience. It is about discipline. It is about clarity. Most people lose money not because they lack intelligence, but because they lack emotional control. Buffett mastered emotional control. Closing reflection. True investing success does not require constant action. It requires correct action at the right time. It does not require prediction. It requires preparation. It does not require complexity. It requires understanding. Warren Buffett built extraordinary wealth by doing ordinary things exceptionally well for an extraordinary length of time. And that is the real lesson.